No. Okay. Well, let's get started because we got a lot to cover. As you heard these gentlemen mention, the knowledge is going to be flying around here in a second, but we're already seeing it happen. Thank you to anonymous attendee for setting the culture here, which is we want to start to aggregate questions. Our goal is to go 40 minutes of dialogue amongst this group, and then we're going to come to you all. And so if you can start right now populating questions in the Q&A section, we will sort through them. In the last 20 minutes of this, make sure that we cover as many of them as possible. So that is the expectation of you all today, is that you are here to participate. I always say with these webinars, get selfish, make it about you, write 5 questions, get your very specific problem answered and get the most out of these minds that you can. That's the best way to use this platform. So Rohit's going to be moderating that as we go through it, and we will get started. So we appreciate everyone coming. For the record, my name is Taylor. I am the CEO of Common Thread Collective. We are an e-commerce growth agency that focuses on helping brands generate predictable, profitable growth. And this event was put together by this man right here. He's to my left. I don't know where he is on your Zoom box, but Mr. Rohit, the CEO of Zamp. Rohit, you want to give us a quick line on what Zamp is?
Yeah, so Zamp is a managed sales tax solution for hundreds of high growth brands. And first of all, thank you to Taylor. Thank you to all the guys here, Dan, Daniel, Tanner. Appreciate you guys for making this happen.
Yeah, so we're 1 week past tax day. So we tried to initially get it out right on tax day, but these 3 guys were too stressed out, so we had to give them a week to chill out. So if you followed any of my content lately, you know that my passion is about bringing together the worlds of marketing and finance. And so that is our hope here today, is to have conversations directly with 3 CFOs. And one of the ways that we talk about bridging this gap between marketing and finance is to bring marketing leaders into more financial spaces. That's something I care a lot about. But in order to do that, we have to reciprocate. We have to be willing to bring the finance leaders into some marketing spaces. So I don't know that these gentlemen have been on webinars very often. They're usually stuck behind their spreadsheets in rooms with minimal light, but they've got their lighting today and they're here to join us in this space, and we're lucky for it. And so I'm going to let them all introduce themselves before we get started. Tanner, why don't you kick us off? Who are you? And tell us a little bit about what you do.
Yeah, so Tanner Land, the CFO at Cozy Earth. I've been with Cozy about 4 years. When I started, we had just done 5 million in revenue on our website, and this last year we were well into 9 figures. So I also manage the supply chain and operations for our business. So some of what I contribute today will come from a place of pure trauma, trying to scale the business during that time. A lot of good things going on, but I'm excited to share the floor with Daniel, Dan, Taylor, Rohit. Thanks for setting this up. Yeah, really excited to dive into this topic.
Awesome. Dan Larson.
Thanks, Taylor. Hey, Dan Larson, CFO at Dr. Squatch. Background originally was in investment banking and private equity. Joined the Squatch team about 4 years ago, a little over 4 years ago. It was the Monday before the Friday where the pandemic really started. So it's an interesting time to be at a hygiene and soap-based company during a global health pandemic. But yeah, first finance hire at the company, and have seen it when we were a ragtag group of 15, and now we've got a little over 200 folks, well into the 9-figure club with Tanner.
Awesome. Daniel.
Yeah, thanks, Taylor. Excited to be part of this discussion. So Daniel Welch, CFO at Kate Farms. We make nutrition shakes and blended meals primarily for the medical space. So you think about supplemental nutrition and clinical nutrition, but we also make consumer-facing products as well that we primarily sell through e-commerce, our website, Amazon.com, and dozens of other online marketplaces. And just started with a retail pilot in a local geography, a confined geography. So really expanding our products far and wide. Prior to that, I was the CFO at Aura, makers of the Aura Ring. Was with that organization for about 3 years, scaled from, I think during the time I was there, we scaled revenue by about 5x. So saw a tremendous amount of growth there. And then before that was running corporate finance at Sonos, a home audio company. And that was a really cool, fun experience. It was my first job out of the investment banking world, where I spent the first half of my career. Yeah, excited to be here, talk about how I've been able to integrate with marketing, in high growth companies, there's that constant tension. And so, yeah, excited to talk about it and maybe learn some tips and tricks from these guys.
Awesome. Appreciate it. So I want to start this conversation around planning, and then we're going to work our way through execution and then a little bit about the market generally. And I think what's cool about this group of people is that we have a very diverse set of brands in terms of the categories that you all represent, possibly the governance structures and capitalization that exists for each brand. And so, Dan, I'm going to start with you, but can you describe how your organization builds the financial plan for the company? And if you can include a little insight into the unique ownership, capital, and governance structures of your company, I think that'd be helpful to generate the distinction between you all.
Yeah, sure. Thanks, Taylor. Well, certainly it's been a journey. Over 4 years, our budgeting process, our forecasting process has changed dramatically. And then, as you alluded to, the market that we're operating in has also changed significantly. So, our planning process when we began, we were 100% e-commerce, and now we're, fully omni-channel, selling into retail internationally, and still online. And the planning for all those is pretty different, but I think what's always been important for me is to recognize that in finance and accounting, we're often a support center for a lot of the other departments and business functions at the company. And so when we start our plan, we're usually reaching out to the other department heads and saying, hey, what do you think is achievable this year? What do you think it's going to take to get there? From labor additions, marketing spend, internal events budget if you're working with your people and culture, HR teams. And then really important for us to be the realists in those conversations and understand how aggressive or conservative are, the different plans that the different business leaders are giving us. And, that's both having the context of how things done in the past, and then also just having a good relationship with those folks and understanding, the personality types where some people might be a bit more ambitious or a bit more, shoot for the stars. Some people might, tend to sandbag more. It's our job to try to put those on an equal footing, and we bring it all together, work with our CEO, sometimes go straight to the board at that point and say, hey, if this is what we achieved, would we be satisfied with that result? Typically, from that starting point, you go back to the drawing board and say, what can we pull out? Where should we lean in more heavily? Where are the areas of highest risk, and how can we potentially invest to protect against those risks? And then that's usually how we end up settling at an original forecast for the year. And then really important for us is we maintain a live version that's constantly updated. I think especially when you're in really high growth phase of the company, or when you're going through, we're acquiring customers online, and advertising, customer acquisition costs have changed dramatically over the last couple of years. Being really eyes up about where the nose of the plane is heading, and being very communicative to other leaders or to your board on how you think that might play out, so you can change course if you need to, has been really important. And then one thing that we've kind of built in more recently is making sure that we have a not only live plan for the year, but a longer range plan, 3 to 5 year plan that we're revisiting quarterly, and making sure we're making investments today that, and we have the deadlines visible as early as possible, so we know we can achieve that longer range plan. And then as far as governance, we're private equity owned, but maybe the only kind of unique aspect of our governance structure is we did receive our B Corp certification a few years ago, which, for those who don't know, it's a designation for businesses that meet a high standard of performance, accountability, transparency on factors that impact employee benefits, charitable giving, or sustainable business practices. So that's probably the newest thing we pushed through that we think was reflective of the work we're trying to do with our customers and our employees.
That's great. So do you guys actually have a responsibility to provide a financial plan to maintain that status? Is that part of it? Are there obligations therein?
Yeah, there's it's less so financial plan. It's more so, there's a huge long list of criteria that when you work with, the B Corp group that gives the certification, it gives you grades on how you're performing in a lot of these different areas. We felt like we were in a really good position going into it. And so in the initial evaluation, we kind of passed the threshold already. Oftentimes, I think, you're trying to get that designation, and you might need to make some changes how you operate to get over the hurdles. But every year that you're working with them, the bar gets a little bit higher. And so I think it does a good job of keeping us, honest and accountable, and trying to operate, in a ethically responsible way.
It's awesome. There's a couple of things that you said that I've written down that I want to come back to, but I'm going to come to you guys next to hear. Daniel, how is your plan similar or different to that process that Dan described? Tell us a little about what you guys do at Kate Farms.
Yeah, I think there's a lot of similarities in what Dan described. I think maybe to step back for a second, both my current organization and the organization I was at before this at Aura, I joined at a time when there was a needed transition from sort of a top-down forecasting style to more of a bottom-up forecasting style. And so I find that to be a sort of a natural progression in growth companies as when you're doubling every year or more, it's easy to sort of lick your thumb and stick it in the wind and say, hey, next year we're going to grow by 100%. And, you might be off by a little bit, but the implications of being off are not quite as critical.
Well, real fast, Daniel, will you describe the difference between those two things? Because I think
Yeah,
those phrases.
Yeah, exactly. So my observation has been historically when companies sort of mature from startups phase, they're typically they're targeting a growth percentage for revenue at the top line and saying, hey, we've kind of doubled this business every year. There's no reason we can't grow 100%. So they sort of project next year at 100% and then work down the P&L from there. And it's purely a financial engineering exercise in some ways. And then as the business grows, as the business penetrates its addressable market more substantially, and as the business grows in complexity, whether it's expanding into an omni-channel sort of environment, it becomes much more critical to do a bottom up. So that is, let's go to our sales organization, let's go to our marketing organization, let's look at the data. What do we think? What are the demand signals that are out there, and what do we think that implies about our ability to hit a certain revenue target? And so I've had to implement both of those processes in this company and my prior company and make that transition from just hey, we're going to target X% growth next year to really understanding what are the key drivers of that growth and what are the levers we're going to pull as an organization to achieve that growth. And that becomes the basis for the plan. And obviously that can be a challenging transition to make for some organizations because it's a much more involved process. But what you typically find if it's done right is you get a lot more people who have ownership over the process. And there's accountability that starts to get infused across the organization for achieving some of these targets. And maybe specifically on that accountability point, what I found is that in that process of building the plan, you need to achieve this sort of healthy tension between the sales and marketing side of the organization and the finance and sort of executive team and board expectations, right? And that's sort of the CFO's job, is to walk that fine line of, I want to put projections together that are just ambitious enough that they make my sales and marketing team a little bit uncomfortable, but also that are not so outlandish that they can't be achieved given the tools and sort of the market signals that we see today. And when that balance is right, then everyone has the right level of accountability and structure. And of course, you have to sort of maintenance that throughout the year and test it and make sure that it's working correctly. But yeah, that's probably my perspective on this particular topic.
Yeah, that's great. I love the designation of sort of that person who's holding the tension between multiple stakeholders, representing multiple versions of a plan that both incentivize the best possible scenario, as well as managing to, under promise, over deliver in certain settings. It's different in every case. So it's a helpful context. And I think that's really important. I'm just going to try and translate for marketers sometimes here as we go, is that to understand the role your CFO plays when they plan and why they might push back, what might be the incentive to expect something different. Where does their role sit? Who do they hold responsibility to? The more you understand the intimate obligations that they have, the better you can help in that interaction. So Tanner, what about you guys? How are you doing this at Cozy Earth?
Yeah, I'll give a little bit of background kind of about our structure. Cozy Earth was founded 14 years ago, originally as a top of bed company. So bed sheets, linens, comforters, things like that. And it was really a friends and family business. The founder, our main founder, Tyler Howells, who's still involved and is a CEO today, kind of got with some family and friends, raised a little bit of money to pursue this. And so The outcome for those shareholders, which I was, fortunate to work with for the first year that I was at Cozy Earth, was different than the desired outcome from the private equity group that came in, took the friends and family out and changed. So I think the approach to that changes a little bit based on kind of the shareholder makeup and the company goals. So previously it was, hey, we don't want to pay very many taxes, so we don't want to show that we're making a lot of money, but we'd like to have some good cash flow. And so we'd implement some strategies to do that. Now in the business, we're trying to drive shareholder equity or the enterprise value of the business long term. And so I think that, having that context for you guys might help understand kind of our process a little bit better. So my job is to hopefully create a financial plan within the organization that can drive long-term shareholder value. And so a little bit of background there on how it works. So right now we're majority owned by a private equity group that at some point, in the next 3-5 years, we're going to sell the business and they need to get some financial gain from selling the business. So we're trying to take it from where it was when they came in and grow it and multiply. So the mandate that we have, it kind of come together as an executive team and a board, is we are going to try to push growth as far as we can within a parameter of profitability. So what that may look like for us is each year we're trying to get slightly more profitable as we continue to grow the business, but we are trying to invest as many dollars as possible back into marketing to be able to acquire as many customers as possible profitably. Now, I'm not going to make something up and say we are first purchase profitable, because we're not. We're more of an LTV play, but we're not far off. And so we know and have created a plan that allows us to push growth while still maintaining profitability and a reasonable rate of profitability. So kind of holistic picture there, the blocking and tackling is very similar to what Dan and Daniel described. We go to department heads and we say, this is where you're trending towards for this year. This happens generally the very beginning of Q4 for us. October is a little bit slower, but as we ramp into November, December, we don't want people getting their focus away from capturing all the demand that we have during the holiday season. And so we're really a couple weeks of iterations back and forth with department heads on what they think they're going to need as far as resources for next year, and really to build into whatever the marketing team puts together as from a revenue forecast. And like Daniel mentioned, that's changed over time too, because we were top down. Now we do bottoms up, but we do it from two different levels: one, the marketing side, and two, the supply chain side. So we take an approach where we forecast out by SKU based on historical demand and seasonality and where we think that's going to drive revenue. But then marketing takes it more from a cohort perspective, where they look at all of our historical cohorts and the rate at which they come back and purchase and how frequently during which seasons. And then we layer on acquisition on top of that. So we kind of the marketing team will forecast out based on retention based and acquisition based. Supply chain, we forecast out based on SKU demand and historical seasonality. And then we bring that together and we come to kind of a consensus on where we think we'll be based on some anecdotal information. We're going to be maybe a little bit more promotional during certain times of the year, or less promotional than we were previously. So there's a lot of information that goes into that. But I think, for us, it comes down to how do we all get aligned to the same goal, which is driving shareholder value long term. And if we can grow, top line at X% while maintaining a level of profitability, that's what we're focused on.
I love that. Thank you, guys. That was thorough. I want to synthesize a few things for the audience here. One is this idea of shareholder value and how shareholders intend to realize their value, right? In an e-commerce business, there's multiple mechanisms for liquidity, and they sort of lead to very different strategic initiatives, especially in a business where cash flow can be hard to generate given inventory constraints, right? So depending on how your shareholders intend to realize their value, you as a marketer may suggest a different path of action. And so it is really important that we don't just stop at, okay, give me the financial goal. It's to understand intimately who the business exists to serve, how they intend to realize value, and then down from that, you can begin to build a strategy. And so that's a space where marketers can walk further down the path of understanding how their business is uniquely positioned. All right, I want to go to the relationship side, because I heard you guys mention a couple different things. Dan, I heard you use this phrase, you like to hear from your team what is possible. So you asked them to sort of represent this upper bound of possibility. Daniel, you use the phrase healthy tension in describing the relationship between maybe different sides of the organization representing possibilities. And I saw yesterday a tweet from Ryan Rouse, who some of you guys might know. He was one of the founders of Factor Meals. And he was at a conference that Deloitte put on, and he said that he shared this data. He said, one of the interesting data points that came from Deloitte's research was that the CMO had the least amount of collaboration with other members of the C-suite historically. And so I'm interested, and we think about this idea of healthy tension and the information that you guys represent. I'd be curious if you guys could describe your relationship with your marketing leader and how you align your goals and performance incentives across marketing and finance. So Daniel, I'm going to come to you first. Tell me a little bit about who is your marketing leader, what is your relationship like, and how do you guys create shared incentives?
Yeah, so we did a little bit of a reorganization in our company at the beginning of this year. We had a chief commercial officer who rotated into more of a traditional chief marketing officer role. And then we also have a head of sales who got elevated into an executive level role. So for Kate Farms, because we are heavily sold into the medical channel, we have, I guess you could call it a traditional sort of medical sales force, and that's a big chunk of our employees, and that's probably 80% of our revenue is sold through them. So hospitals, home care organizations, and driven by healthcare provider recommendations. So understanding what's going on in the sales force is really important, and then freeing up our previous chief commercial officer to focus on marketing, brand building, e-commerce, and then our retail launch was critical so that we could sort of dual track these things. Specifically to the question on relationship, I've found that it is absolutely critical for finance to be highly integrated with marketing, because in high growth organizations, especially consumer facing organizations, because as many of you probably know, marketing and building awareness with consumers can be very expensive. That is one of the highest risk areas of the P&L that can get out of whack. And so having the right KPI feedback loop, having the right meeting cadence, and just really relationship building, right? Like having really strong relationships with the CMO and on down through the CMO's organization, I think is really critical for finance to have a pulse on the effectiveness of some of these things and some of the campaigns and some of the initiatives that are being driven on the marketing side, and to interpret and digest that feedback in real time so that we can make course corrections as needed.
That's great. Tanner, I know you're head of marketing pretty well. You guys seem to have a friendly, playful banter amongst each other. Tell us a little bit about how you work together and how you create shared incentive across the organization.
Yeah, so our head of marketing, a guy named George Davis, he's been with the organization, I don't know, 6 years or so, and started kind of in customer service. And I think he has a unique perspective because he started talking to the customer all the time. And he's phenomenal in a lot of ways. And I'm fortunate to have him because he is very numbers focused, and he wants to do right by the organization, not just by his org. So George is great. I think it is the most critical relationship in the business. There is not a more important relationship that at least can impact the outcome as much as the relationship we have. Some of that is because I also run operations and inventory, and so that plays into it. So yeah, I think across the organization, we kind of start with the same goal of, hey, we're going to grow while maintaining this level of profitability. And so we try to align incentives to that. Each department within marketing, whether it's retention or audio or maybe direct mail, digital, we all have individual kind of KPIs or individual metrics that we're driving to. A lot of it is growth. Some of it is profitability or return on spend, different things that we talk about and hear about in e-commerce a lot. But overall, unless the company hits its minimum growth and minimum profitability objective, no one gets paid out anything. And so the financial incentives are aligned that way. There's also an equity component to that for those people that get to participate in that plan, that we're trying all to create shareholder value to drive to that long-term end goal. And so we have specific incentives, financial incentives set up annually to drive to the plan and to hit targets and to align it across incentives. But I think, for me and our organization, having that partnership with marketing and having someone who kind of speaks a little bit, at least, to the language of finance has been really helpful, and has allowed us to kind of disseminate that information to to the team across the board. And I've had to frankly learn a lot of marketing lingo as well. I try to listen to e-commerce playbook and a lot of different other podcasts to try to honestly just better understand all these terminology and different channels and how we might approach different things. So it's a push-pull. We don't always get along. When we golf, we definitely don't get along, but we are working towards the same objective. And I think coming from that baseline, it's a really good relationship.
I want to touch on
go
something
ahead. Go,
that,
Daniel. Go.
Yeah, I was just going to follow up on something Tanner said, which is having folks on the marketing side that are numbers people is really critical. And so, whether your organization is thinking about hiring, its first CMO, or the finance organization has to do some education for the marketing team just on KPIs and return metrics and stuff. And some of that's innate to marketing, but they look at things slightly differently than maybe how finance does on the P&L side. So having someone in the organization, a leader in the organization who's very numbers driven is really, really critical to success, I've found. And it's especially important when you get to the IPO exit stage, because as I like to say, when you become a public company, every leader in the company becomes a finance person.
So this is great. And Dan, I'm going to come to you this, because I think my perception of the biggest gap in this problem is a language barrier. It is that we speak in different words. The finance folks might be talking about EBITDA and weighted cost of capital and gross margin, and the marketing folks are talking about click-through rates and ROAS and different things altogether. And so you're literally speaking two foreign languages. So I'm curious, Dan, how have you found shared language with marketing? And what do you guys both understand? And how do you improve communication so that there isn't this gap in terminology between two different sides of the org?
Yeah, I think there's a few things that have been very effective for us. First, I think, and just important for any finance accounting org, is just the consistency. So, being able to put out accurate financials that are reliable and come out quickly and in a similar format for folks, because I think as you're trying to get people up the education ramp, being able to look at the same metrics that are calculated the same way consistently is really necessary for creating a base floor. Beyond that, we're pretty open with how much we share across the org through our financials. But what we do, we try to do is really tailor what we're sharing to, be very audience specific. So when we're reconciling our financials at the end of a month and kind of synthesizing, summarizing, we'll have different cutouts that can go to, each different department that might be what they're, what's most relevant for them. And I think that's been super important. But as far as the language goes, I think we also try to be mindful, the folks on our finance team at Dr. Squatch, that, we know a little bit about a lot of areas of the company, but we're not going to be the subject matter experts in everything marketing. And so you really need to build that back and forth and that trust, and then, kind of act as a voice of reason sometimes. And I think where you really see benefit from that is when things are going slightly off plan. If you can have that open dialogue with different, department heads or folks throughout the organization, you can figure out what the right kind of course correction might look like. And so, for instance, if you're, I think probably all of us saw a very different ad environment pre, Apple iOS change in spring of 2021. And it's been much different after that. And I think, in a low trust, low communication environment, you might have some folks that still feel like they need to be putting out forecasts that had a degree of optimism reflected in them that might have made sense in 2020, but in 2022 look really different. And I think when we all know that we're pulling in the same direction and working on the same team, you can have realistic conversations, say, hey, like, we understand costs might be going up here. We're not holding you to metrics that are in an old e-com environment. We're in a new place here. And hey, when we're looking at the trend line, what you're saying that you think is possible, let's just kind of pressure test it a little, because it doesn't really benefit anyone in the organization to, I think, have unrealistic expectations or incentives that are impossible to match. And that's, I think Daniel said it really well, where just like creating that tension of achievable and realistic while still ambitious is super important.
I want to add to that, if I can, real quick. I think, you asked a question, Taylor, like, how do you speak the same language, right? I think there's some, I don't know what the audience necessarily, if it's more finance or marketing people, there's a few things, for us that everyone knows, that everyone speaks. We all know what gross profit percentage means for our business. And that is, okay, what does it cost to deliver to the customer, after revenue? So if revenue is $100 and your cost of delivery is $40, okay, your gross profit is $60 or 60%. And then contribution margin is the next item we look at, which is essentially you take that gross profit and you subtract out all your advertising and marketing costs, and you get to a contribution margin. And those are the two that we talk about all the time. And then you have your OpEx, which hopefully you're leveraging over time, right? It's not growing at a same rate with sales. Hopefully you're leveraging your ad spend as well. But I think for us, those are the three areas that we look at, and we look at it across the board. Marketing doesn't only look at marketing and ad spend. Marketing looks at gross profit, because how they promote and how they discount affects gross profit, right? And it also affects product makeup. If they're marketing at our business sheets, they might carry a lower margin than pajamas. And so if we market sheets really heavily, that's going to impact our margin. And so if we can speak that language on, hey, here's our gross margin, here's our contribution margin, and here's kind of our profit or income, that has helped us dramatically across the board if everyone knows kind of those key areas.
Yeah, I might add one thing to that, and that is kind of what I refer to when I talked about education for the marketing team. And what I found more often than not is that marketing sometimes has their own way of calculating metrics like return, LTV, contribution margin, and not all, and they're not necessarily wrong, but they don't always necessarily align to the P&L or the income statement version of that. So I've in both at Kate Farms and at Aura, I'd invest a lot of time and energy into, hey, let's get alignment between marketing and finance as to what you're looking at marketing when you look at a ROAS or a contribution margin percentage. How does that actually translate once it hits the P&L? Because there may be other things that come out of that. And actually a really good example of this is less of a P&L metric, is subscriptions. So for those of you who have subscription businesses at Kate Farms, we have people use our products, for long periods of time because of medical needs, and they are on subscriptions a lot of time. When I was at Aura, we implemented a subscription service for the software. And one of the things, there's a couple of different ways to calculate LTV as a really good tactical example. And what I found is more often than not, marketing organizations tend to calculate LTV as revenue on a revenue basis only, whereas finance organizations tend to calculate LTV on a gross profit or even on a gross margin, which is even more punitive. And so taking that more conservative view can actually influence your behavior in quite different ways. And so just getting education to bridge that gap between the two different, data environments and KPI reporting environments, and then making sure that the marketing folks understand how that stuff actually shows up in the income statement is really important.
You're getting to something so critical, is that in this world, every word should be accompanied by an equation. And I would encourage every brand that in every sheet that you build, if you publish a metric, publish next to it the corresponding formula that calculates it. I can tell you, as an agency that sits in the midst of working with 100 brands, everyone says the word sales and they mean something different. Some people mean net sales. Some people mean gross sales. Some people mean order revenue. Some people mean net sales, add back tax, for my guy Rahit over here, right? Like, everybody's got a different version of these words. And if you don't create shared meaning, there is no shared understanding. And so it's so critical. And I've seen this in few organizations where literally every spreadsheet, every metric has a corresponding formula published next to it, the term. And that's literally like a dictionary for words in this world that gets to exactly what you're describing, Daniel. And we have this disease. I think it starts with average order value is where this term got corrupted, where we substitute V, value, for revenue, and it screwed up everything. So if we could get rid of AOV, I think we could solve this problem, because value should always be a gross profit statement, in my opinion. All right. I want to go to a quick hitter. We've got a couple minutes left. Daniel, you mentioned it. I'm curious, in your organization, the 3 core financial documents, P&L, balance sheet, cash flow statement, who has access to them and why? Just real quick, what level has access to each of those documents?
We are pretty open as an organization. So at the end of when we close every month, we have an all hands meeting probably a week or two later, and we disclose everything. Actually, we probably don't put a balance sheet in there because it's a little more confusing to communicate at large. But the ELT, the VP level has access to financial statements. And certainly if anyone asked, we would probably send them around.
Love it.
Yeah, that's the same at Dr. Squatch. We try to have an all hands. And I think what we've tried to play with is what's the right level for that broadest audience to be, informative and motivating without having people lost in a long financial disclosure. But then when we get to the, extended leadership team, obviously board level, pretty full transparency.
Yeah, we're pretty similar. I mean, we go through a P&L in detail every month, or we should, and sometimes it gets pushed, or sometimes it doesn't. But we should be going through the P&L every month with the marketing team in not necessarily every line item. They don't need to, not everyone needs to look at every single line item. I think across the organization, we share it as needed. We would have no problem sharing it if people were interested, and I'd have no problem sitting down and explaining it in greater detail. At the leadership level, everyone sees it, just kind of the cadence of our meetings, but I think more transparency, better.
I love it. And I would encourage, this is one of the areas where I think finance can unintentionally gatekeep information under the pretense that they assume people couldn't understand. And what I'll tell you is attribution is 100 times more confusing than any balance sheet I've ever read. So if you believe in your people's capacity to try and sort out that question, they can certainly sort out the cash flow statement as well. And that level of understanding actually enables people to solve the same problem you're trying to. So appreciate you guys being willing to do that. All right. Last, we're going to go to a piece of advice, then we're going to questions. All right. The world has obviously dramatically shifted since, Dan, it's hilarious. When I looked up your start date, you literally did start the Friday before COVID. So you've been on quite the roller coaster, sir, since your time. But I saw a data point that we are down 97% in venture financing from the peak of 2021. And the average cost of debt capital in that same time is up 200%. So net, there's no money available right now. And so I'd be curious how you each would advise earlier stage brands, let's say in the early 8 figures range, in operating in an environment where capital is scarce and maybe not available at all. How does that change your behavior? Tanner, I'll start with you.
I mean, make a profit. I guess that's like, at the end of the day, businesses are around to produce value, and there's so many wonderful benefits of businesses, right? But they all need capital. You can't employ people without dollars. You can't build something without having money. And so, first order would be to make profit. And if you have access to some sort of capital markets, there are alternative financing. There's revenue financing options. There's Wayflyer. There's Clearco. There's a bunch of different options. Early stage, we weren't able to get bank financing, I would say, until we were, or at least meaningful bank financing until we were in the $25 million revenue range and making money. I don't know if that's been true for Dan or Daniel. But yeah, I would say, if you can get to first purchase profitability, that's going to be your best way to grow. If you can't, find some revenue or inventory financing options, which there are many, that will allow you to capture dollars before you have to pay for them. So for example, if you can get 90-day financing on your inventory, but you can sell through that inventory in 45 days, you've essentially been able to generate cash flow without having to outlay money. And so, those are generally higher costs, 15 to 20% on an APR basis. Maybe they're even higher now. I don't look at those options as much anymore. But yeah, if you can get revenue or inventory-based financing, great. If you have credit cards and you can float stuff for 30 days, like I think we all did that at certain parts of the business, you have to. Without that, yeah, you just have to be profitable.
Daniel, go ahead. I saw you unmute. You're raring to go.
No, I was going to say, I don't know if I have anything to add to that. It's, control your own destiny. So first order of business is unit economics and profitability. So whatever you have to do to get there. And yeah, there's incremental access to liquidity. It's probably not on the same terms that it was 2 or 3 years ago. But certainly having access to liquidity is paramount, whether it's self-generated or external. And then, I think Tanner touched on one that maybe goes overlooked, which is the working capital cycle. And so to the best you can optimize for, receivables and payables, that can create some incremental relief right away. But yeah, top priority is strong unit economics and getting to cash flow positive, for a growth business. And sometimes that means you got to sacrifice growth, right? Like you might not be able to grow 100% a year. You might have to grow 50% a year because you don't have as much dollars to put to work in customer acquisition. But you iterate until you get that unit economic equation right.
Love it. Marketers, another thing you can understand. How does your organization's cost of capital affect the return on investment that you need in advertising? It is almost always neglected when I see calculations around targets for acquisition. So go and ask, go understand how your business is utilizing working capital, what the terms are on it, and how that affects the actual margin profile of the product. Dan, what about you? You obviously started and lived through a very different eras. How has your business changed, and what would you recommend people do?
Yeah, I mean, well, I think Tanner and Daniel hit the right point here, and which would be my headline point as well, is just focusing on profitability is really crucial, especially in a less certain online ad space environment. We were really fortunate that our founder kind of shared that or instilled that in us, and so we were definitely still focusing on being cash flow positive, being EBITDA positive, even when we were in the kind of pre-2022 growth at all costs mentality. And so I think that's helped us. I think certainly for companies that are, I think almost every company probably starting now in the last year or two is probably starting from that page. I definitely, to both Daniel and Tanner's point here, if you were operating with, whatever the business plan was pre-2022, I think being nimble and being aware that the environment has changed and you want to be able to move quickly and make those adjustments, building bottoms up rather than focusing on top down, like Daniel was saying, I think is super key. And then I think specifically as it relates to online advertising spend, just being really careful that you don't get addicted to the growth that can come from expensive ad spend. Typically you see CAC only going in one direction, and it's usually up. And being, really mindful that you're not basing all of your future growth and future planning on what you think the CAC, will or might be, because it's can be painful to unwind from.
I had $1 for every forecast that included increased spend at a flat CAC. I'd have a few dollars. All right, let's get through some attendee questions. And this is the benefit, man. You are going to get the best possible answer you could ever imagine right here. So this is for you, Daniel, from one CPG beverage company to another, even though, I don't know if you guys categorize yourself as a beverage company, but you sell things people drink. So how do you manage expectations or mandates from investors / PE to aggressively grow top line? In this case, he's saying 100% year over year, but also grow your profit at a similar clip. So maybe the broader question about managing investor expectations here.
Yeah, this is a great question. I think I saw a meme on LinkedIn or some other social media about boards and their demand to grow the top line or double the business, but also be profitable and all the other demands that seem to be at odds in today's environment. It's a good question. I think that first and foremost, you as a CFO, you are operating the business to provide a return to shareholders. So ultimately, shareholders have the say in what the risk profile is, what the ideal outcome is, what the return threshold should be. And so I think the way I would answer this is to say you really need alignment there. And yes, investors who are not operating the business day to day are going to have expectations that you can grow and be profitable and do things that are seemingly at odds. I think the way to get buy-in is to thoughtfully prepare scenario planning and show, hey, look, here's what we can do if we're profitable. We don't have as much to invest in raising brand awareness or entering new channels. And so we're going to have to delay those things. And here's what, here's a scenario where we generate 20% EBITDA margins for the next, 3 to 5 years. Here's a scenario where maybe we're break even, but we can plow more money into growth and present those to the board and to the shareholders, that are involved in that decision making. And the goal being to just get alignment from stakeholders as to what is involved and what the relative risks and trade-offs are for each of those different paths, so that when you go to execute, you know that you're executing on the plan. And they may come back and say, you know what, we want profitability only. Who cares about growth? And that'll be challenging maybe for an organization that has historically pursued growth, even at the risk of profitability. And they may say the opposite. They may say, hey, let's double down and take market share. And we're standing by ready to fund the company to do so. But I think it's just having that buy-in from them that's really critical. And it just comes from communication.
Yeah, learning the art of scenario planning. It's like great software pricing. There's a high, a low, and then this kind of one that I like right here in the middle. It's quite the art. So good stuff, man. All right, Tanner, Dan, you guys are both in similar situations in that you've been through one sort of round of sort of acquisition or financing in participation here. You're now reaching that threshold where you begin to look at the upper bound exits, whether that's going public or a large acquisition. But the reality is that it's kind of been a bloodbath in the public markets for consumer brands, if we're being honest, over the last 2.5 years. And that's obviously put downward pressure on all pricing and opportunity for exit. So how do you guys see the current macro market, and how do you think about the opportunities related to M&A for your businesses in the future?
Yeah, I'll start there. I think, we look at opportunities to acquire other businesses. And so we are kind of, active on the other side of that as well. I think for the exit value for us, it is not the best time to go public. I think you see Allbirds, you see a lot of these different businesses that were D2C heavy, maybe moved into some retail and have lost 95, 98% of their market value in the public markets. And so, yeah, not a great time to go public. I think, that business also isn't making money or is losing tens or hundreds of millions of dollars. I think this last year they lost $200 or $100 million on $220 million in revenue, something like that. So I can understand why the value is where it is for that business. If you run a good business, I think there's still opportunities in the market for M&A. You may not get the multiples of 2021. I don't know that we're ever going to see that again in consumer or in e-com, unless you have a really good revenue base, meaning it's a subscription revenue, really high quality revenue. That's where you see the higher multiples. And so as you're building your business for exit activity, I think if you can build very high quality revenue and build a business that is scalable and profitable, there's still really good opportunities in the horizon. And so I would say you just have to focus on trying to build the best business you can, and those things will kind of take care of themselves. Now, there are certain things you may optimize within a 3-year period of when you expect to sell. But for the most part, if you run a really good business, if you have high quality revenue, if you have good retention metrics, and a good product path, there's still opportunity in the market. Probably not as interesting for the next 12 months, maybe 18 months, but I think it starts to get better post that. And obviously, if interest rates move at all and come down, I think you start to see a lot more activity there. So I don't know, Dan might have better thoughts than me.
Yeah, no, I think I agree with the sentiment there. And I think particularly for consumer brands and companies, I think that, you can only control so much. You can't control what the market's doing broadly, but, I think to put yourself in the best position for a really good outcome, you just have to build a really strong company, like Tanner's saying, and keep investing in the brand. And so I think, we're fortunate our private equity owners share the same perspective of, let's try to put this company on the trajectory to be the largest personal care company in North America and in Europe. Let's try to invest in such a way that we're trying to be as big as possible, and then we can be opportunistic when it comes to when's the right time to exit. But we kind of want that, our destiny to be in our hands. I think that's what Daniel's saying there. And and just keep it up in mind.
Do any of you guys have a macroeconomic input in your forecast where you allow sort of your sense of the broader economy to dictate expectation?
We do
I
not.
think it kind of comes through a little bit with some of our e-commerce forecasting, and that's less kind of GDP output, but certainly macro trends with more consumers shopping in stores versus online, or some of that trend or that acceleration towards online shopping slowing down versus where we were in COVID. So that's probably where I'd say it lives for us.
Yeah, similar for us as well. And we
Yeah.
feed interest rates into like cash balance forecasting, but Yeah, it mostly comes through in consumer sentiment and demand planning.
Yeah, I
Yeah.
would just add to that. It's all, we don't have any, assumption that we can change based on where interest rates are or things like that. It's more, how are retail sales trending over last year, and we take some information there, but frankly, not a lot.
Great. Dan, talk to us a little bit about the finance stack. Let's get technical for a second. What are you using for accounting, banking, credit cards, debt facilities, anything that in your journey has been incredibly helpful from a tools perspective?
Yeah, definitely. So, I mean, accounting systems, you're kind of gonna grow into the system that makes most sense for you. And I've been through a couple systems implementations in my tenure here. So we were on Xero and then QuickBooks. Now we're on NetSuite. I think rule of thumb for any finance listeners out there, just maybe my cynical approach here, expect any implementation to take twice as long and be twice as expensive. If it's not, then great. But go in with that being the assumption, because people are going to promise you otherwise, and then you're going to set yourself up for disappointment. As far as banking, we moved to one of the big banks post the Silicon Valley situation, but we are diversified across a couple of bank accounts there. Credit cards, I actually think this is a really strong area for folks to spend time on as they're growing their company. When we were in our earliest stages, we were using some of the bigger kind of incumbent credit card companies, and there's a lot of new companies out there that have much more flexible limits, much easier systems to work with. So we use Row and Brex, and we found them to be really, really good partners with us. And even if when we joined, we might have been on the larger side of a company that they might work with, they've done a really nice job growing with us. And I try to stay loyal to companies that have been really good partners at different stages of our company. And then we have a revolver through a private direct lender, and so we utilize our revolver when we need to for cash flow, working capital needs. But when we're given the interest rate environment, when we're feeling strong from a cash perspective, try to proactively pay down our balance our term loan. And then as far as other software and analytics, maybe my one word of caution here, and curious, Daniel and Tanner, if you agree with this, but I think there's a lot of software that tries to be the one size fits all solution for pitching into CFO or the finance seat. And I'm still open-minded, but I haven't found anything that does seem to be a perfect one size fits all. At the end of the day, you're going to need to have a really good 13-week or forward cash flow forecast. And there are some tools that can pull things in automatically, but it still is going to come down to the discretion of, where do you think your sales are coming from? How much do you expect to spend? And I haven't seen a program that can spit that out more accurately than like the live discretion of some managers.
Yeah, I agree with that.
Yeah, I think, with these types of businesses, and I think everyone knows this, a lot of times it's not a 13, well, for us, based on lead times, it's really hard to do a 13-week cash flow forecast and have confidence down the road, because we buy inventory 6 months in advance. And I'm assuming, a lot of the listeners do too. So, yeah, it's systems is a hard one. I think, to Dan's point, we kind of have a similar thing. We went from QuickBooks to NetSuite. I know there's other ones out there that are more e-commerce focused that might be better for the size of companies listening. Finaloop is another one that I think is becoming really popular. Yeah, and so our debt facilities have evolved over time. Our credit card facilities have evolved over time. We were on a borrowing-based facility where we borrow against the value of our inventory. We're in an asset-based facility now. And then from a credit card perspective, I appreciate what Dan said, because you can find a lot of value in some of these credit card programs. I know we're on one right now that is getting a 3% cash back on spend. And so like that's, there's a term to that. We get that for 12 months, but that's a huge number for us. And it frankly can pay for 10 jobs. So just being able to optimize around, cash back or different things for your business can really provide a lot of potentially extra liquidity, but also some more optionality there. So, if people want to reach out about that, happy to to dive more. Don't want to take the rest of the time talking through that.
Awesome. All right, last one. Is Meta going to beat earnings tomorrow? And are we getting an interest rate cut this year? Let's hear it. Put you guys, I know, get you real uncomfortable in predicting the future. Daniel, you're unmuted. You're ready.
No comment on Meta. I think we'll get an interest rate cut, one cut before the end of the year.
Great. Tanner?
Probably same
Or
sentiment.
Dan?
On my side. Yeah.
Meta beats, even though we hate them sometimes. And yeah, we get one this year. No more than
Look
one.
at this. There we go. We got a bullish group of CFOs, big believers in a bright future. You heard it here. Guys, thank you so much. We really appreciate it. You coming in and share with us. We're excited to drag you out into the spotlight more often. I know as a marketer, I benefit immensely from hearing your perspective on the world, and helps me to inform how I think about communicating. And I hope it does the same for everybody else. And you are examples of the reason I'm bullish on our industry and the future of where we're all headed, because you guys are continuing to produce incredible businesses. So thanks for coming in. Last thing, where can everybody follow you? What's the best place to keep in touch if they have questions or want to interact? Tanner?
Yeah, I'm a boring accountant, so I don't do a lot on socials media. But yeah, I mean, you can reach out on LinkedIn. Happy to connect anytime. I have a Twitter profile. I follow people. I've never posted. I don't know how to work the platform.
Until now, you're coming to
yeah,
life.
maybe I need to start posting. I have actually liked a couple posts, all by Taylor.
Yeah.
And that's, yeah, LinkedIn, easiest way. My email is Tanner@CozyEarth. If you're selling something, I get a lot of those, so good luck. But happy to be helpful any way I can to anyone who reaches out.
Yeah, if you didn't get your question answered, throw him an email. I bet he'd be willing to do it. Daniel, where can people reach you?
Most active on LinkedIn.
Awesome, man. Dan?
Yep. LinkedIn. Similar to Tanner, I'm Dan at Dr. Squatch. Feel free to drop me a line if I can be of any service.
There you go. Hey, flood their inboxes. I mean it. Learn from these guys. They're incredible. Rahit, hey, appreciate you seeing this as important, man, and reaching out and pulling us all together. Check out Zamp. And I'll tell you this, here's my sales tax experience. If you're a smaller e-commerce business and you're looking to sell at any point, understanding and reconciling where and how you've been paying sales tax is the biggest nightmare that will potentially implode your deal from happening. And I mean that. I've seen it happen firsthand. Use these guys to help get ahead of those problems. Thank you all for coming and hanging out. Sticking around for an hour. That level of intimate finance talk is no small task on a Tuesday. So we appreciate all of you. Thanks, guys. And we'll see you all soon.
Thanks, Taylor. Thanks, everybody.
Thanks all. Treat.